Hello, everybody. This is blog number 5, recorded at 7:33 p.m. on Saturday, March 13th, 2021. I am recording this blog because I have hired a personal career coach I'm trying to get to help me learn how to build a writing career. And the grand irony of things is tonight I'm not in the mood to write. I'm in the mood to talk extemporaneously. And the topic, according to my coach, Steven Skura, and he's a good guy. He charges pretty well, very affordable. I left a LinkedIn in the description. LinkedIn link to his description. Well, maybe tonight's not a good night to talk. Anyway, let's get serious. So, the topic is a 500-word article about some current topic in finance. I got a finance degree many years ago, and I've been keeping track of the financial industry and the financial principles and theories as best I can. And I want to start just sort of by brainstorming some ideas, talking through some of my knowledge, some of the experience, some of the conversations I've had with other people. And I would begin with Rich Dad, Poor Dad. It's a good jumping off point. It's a book by Robert Kiyosaki. It's a good book. I will link it in Amazon. I'm not an affiliate to them, but I figure why not read the book. It's pretty good. And they said, basically, from my summary of the book, is we live in a world in America and UK and other countries called capitalism. Our financial structures are built around the preservation and growth of capital. That means labor, which is whenever you clock into a job and get a paycheck, has a depressed value naturally because of the system which makes it so that capital has more value. Let me give an example. Let me try to think of an example at least. In the book Rich Dad, Poor Dad, they talk about how you can pay rent or you can buy a house. The example they use is Monopoly. In Monopoly, what happens is, well, you know the game, you can either buy a house or you can do or trade property and some other things. It's been a while since I played the game. But the key is 4 greenhouses, 1 red mega hotel. And the concept behind this is when you concentrate capital and make it so that people need your services in order to function, you've essentially captured the market. Now, this might sound evil, it might sound bad, and in some property law it could be bad. But the essence is there are some necessities that people have which are scarce. We all need water, but water is not scarce. There are some businesses that can make money off of water, but the novelty in water was a marketing strategy in which they would sell bottled water at a 1,000% premium to tap water. And our family drinks bottled water simply because we don't trust the tap water in West Texas. But we also buy the quarter thing. And again, this is a ramble, so I apologize for not focusing yet. I'm trying to find a focus right now. And I'm at 4 minutes and 20 seconds, and I should very quickly try to find a focus, and this personal blog will end approximately 8 or 9 minutes total. So, what I'm trying to get at is it's a game of scarcity, supply and demand. When people want something or need something and they can't get it on their own, but you have it and you can give it to them, then that's how you make money in economics, in finance, and anything. I'm not fully sure how the stock market works, but I believe the way it works is companies make profit. It's not any company that works on the stock market. There's a lot of screening processes that are natural to that mechanism, like having to file paperwork, having to get legally authorized, and that is a sufficient filter so that only the better companies get on the public exchanges. That's theoretical, and that might not always apply. There's always an Enron, there's always a Kmart, but they got to some point where they were valid enough as a company that they had sustainable cash flows. So in truth, and here's my thread now. I found my thread. Thank you guys for paying attention long enough for me to find my thread. My thread is the financial markets work because you are exchanging time periods of cash flows. It also works sort of like an investment where you put some money into Google, say right now, and they use it to make more money in the future. So it does work as a financial investment too. But the majority of companies like Walmart and even GameStop or Best Buy or Caterpillar, they're not cash strapped, but they do need regular cash flows so that they can do their asset acquisitions and their logistics and all the other aspects of running a company. So they do a trade with you, an arbitrage, a trade. They say, you give us money now, we'll give you money back plus interest. So today's money, we'll give it to us, and based on some risk factors, how risky we are, we will give you more money in the same unit in the future. So let's say you give $100 to GameStop right now, then the way that it would work if they were a dividend yielding company or an asset yielding company is they would promise you a certain rate, and that's how debt markets work. And I'm kind of jumping around, and I'm not re-recording this because the point of a personal blog is to be extemporaneous. And I'm at 7 minutes and 30 seconds, so I apologize. I will need another 2 minutes and 30 seconds to speak. There are many financial vehicles in the stock market and in the global markets in general. One of them is debt, bonds. The traditional one you've seen is where you buy a college bond or an EE bond from the government, and after 15 years, $100 turns into $200. Now, if you do the math, 100% yield over 15 years is 5% maybe. I don't know how to do the compounding. It's 1.05 times 1.05 15 times, or 1.05 to the 15th would equal maybe 2. I'm not positive, but that's my guess. So there's the compound interest, which is a very powerful tool. And it's not one you can rely on some days because it's not guaranteed. Compound interest is not guaranteed. So you can make 5% profit on a financial instrument one year, make 2% another year, make 15% another year, and then lose 20% the next year. But the theory goes in the stock market, and I'm switching from debt to stocks because at the end of the day, you're just trying to make money on money to catch up with inflation and to build a sort of nest egg for yourself. If you can get 8% return in the stock market, realistically, and then take 2% away for inflation every year, that's a 6% gain every year. Now, if you only put money one time, like say $1,000 one time in a stock market. And now this is becoming a conversation about compound interest and how to do the calculations. And I will end with that conversation and then I will record another blog later. But if you get a net gain of 1.06 or 6% return every year you pump money into the stock market. And if you're investing in the stock market for 30, 40 years, you can statistically, if the economy does not destroy itself, and if the economy destroys itself, you have worse problems than losing 10K in the stock market. 1.06 raised to the 30th. And I would need to get out a calculator. And I have one on my phone, fortunately. So let's say you only put, let's see, I need to find my calculator. I apologize for the wait. But, oh, by the way, a good book, I'm going to link it in the description as well, is The Way of the Turtle. I read it in college, and it was pretty good. So 1.06 times, or 1.06 raised to the 30th equals times 1,000. So if you get a 6% return and you put $1,000 into the stock market after 30 returns, and usually it takes a year to get a 1 unit of return, $1,000 after 30 years turns into $5,743. Now that doesn't sound like a lot, and it's not. You waited 30 years to multiply your money by 5, but if you put in if the numbers get weird, because if you put in $300,000 all at once, and you just let it sit for 30 years, that $300,000 becomes $1.5 million. And depending on taxes and other factors, the number could vacillate on what you need. You really need a CPA to work through the tax markets. But the point is to regularly put money in the stock market so that you have a time horizon of compounding. You put $1,000 now, 1 year, next year another 1,000, next year another 1,000, and there's a different flow of compounding. And if you money manage your cash flows properly and money manage your investments properly, you only take out what you need when you need to, and you always have a buffer to save through the harsh times. Because I hate to be a buster of human nature, but in hard times, capital gets cheap and daily expenses get high. If you've ever survived the 2008 housing crash or Hurricane Katrina or the 2020 vaccine crisis, coronavirus crisis, then you know this for a fact. The point isn't to do well now when things are good. The point is to survive when things are bad. When winter is coming, prepare for winter. Just like the grasshopper and the ant story, Aesop's Fables, ironically, is about finance. And, well, you want to build a system of your money management. And unfortunately, not a lot of people do that. I recommend they see a CPA and listen to them. And that's about it. I'm about 13 minutes. Appreciate you guys.